Welcome back to the channel. I'm Algabot, and today we're taking a close, educational look at an expert advisor for MetaTrader 5 called DeMarker Pullback Continuation. This strategy is built around Tom DeMark's DeMarker oscillator, but it uses it in a way that turns the usual textbook approach on its head. Instead of fading extremes, it joins an established trend on a shallow, healthy dip. Over the next few minutes, we'll explore the indicator, the entry and exit logic, the actual code, and a step-by-step chart illustration. Remember, this is educational content only, not financial advice. Let's start with the big picture. DeMarker Pullback Continuation is a trend continuation system. The DeMarker oscillator is normally traded as a mean reversion tool. Traders buy when it sinks to an oversold reading around 0.30 and sell when it climbs to an overbought reading around 0.70. That approach works against the trend, and in a strong market it can get run over. This strategy deliberately flips that idea. The core insight is simple. Inside a genuine trend, a healthy pullback does not drag the oscillator all the way to a deep extreme. It only pushes it back to a shallow reset level, around 0.45 in an uptrend. When momentum re-engages and fresh strength returns, the oscillator climbs back up through its 0.50 midline. That midline reclaim, after a shallow reset and in the direction of the trend, is what the strategy treats as its entry. In other words, the EA is joining the trend on the dip rather than fighting it at an extreme. To make sure it only acts inside a real trend, the strategy adds a trend filter built from an exponential moving average. Price must be on the correct side of that moving average, and the average itself must be sloping with enough conviction. That slope is measured relative to the average true range, so flat and choppy conditions are filtered out before any trade is considered. On the risk side, the strategy is engineered to keep drawdown modest. It places a structural stop just beyond the recent pullback extreme, padded by a fraction of the average true range. If that structural risk is too wide, the trade is simply skipped. The take profit is set as a multiple of the risk taken, and once price moves far enough in favor, the stop is pulled to break even and then trailed. This kind of EA is oriented toward traders who prefer disciplined, rules-based trend participation on liquid instruments. As always, this is for learning purposes, and trading always involves risk, including the risk of loss. Let's walk through the logic in plain English, step by step. Signals are evaluated once per completed bar, while trade management runs continuously. First, the strategy establishes trend context. For a long, the closing price must be above the exponential moving average, and the average must be rising. That rise is measured as an ATR-normalised slope, and it has to clear a minimum threshold set by the slope gate. For a short, the conditions are mirrored. Price below a falling average with enough downward slope. If neither condition holds, the market is treated as flat and nothing is armed. Second comes arming. While an uptrend is confirmed, the strategy watches the DeMarker oscillator. If it dips to or below the shallow reset level, by default 0.45, the setup becomes armed for a long. In a downtrend, the mirror applies. The oscillator must rise to or above 1 minus that level, so around 0.55, to arm a short. This arming stays valid only for a limited window, set by the arm max bar's input. If nothing resolves within that window, the setup is abandoned. Third is the trigger. For an armed long, the strategy waits for the oscillator to cross up through the 0.50 midline, meaning it was at or below 0.50 on the prior bar and above it now. That cross must land on a bullish reclaim bar, where the close is above the open and above the previous close. When both align, the EA signals a long entry. For a short, the oscillator must cross down through 0.50 on a bearish reclaim bar, and the EA signals a short. Now for risk. On entry, the strategy finds the recent swing extreme across the pullback bars and places the stop just beyond it, padded by a fraction of the average true range. If the resulting risk is wider than the maximum risk ATR limit, the trade is skipped entirely. The take profit is placed at the reward to risk multiple, which defaults to 2 times the risk. Finally, once price is 1 risk multiple in profit, the stop is lifted to break even and then trailed by an ATR multiple never loosened. Only one position runs at a time. All of this is educational information, not a recommendation. Let's read through the MQL5 code you see on screen. At the top are the key inputs. DeMarker period sets the oscillator length, defaulting to 14. TrendEmaPeriod drives the moving average trend filter at 50. Slope ATR min is the minimum slope the trend must show. DipLevel is the shallow reset at 0.45. R max bars keeps a setup live for 6 bars. Stop ATR multiple, max risk ATR, and reward risk govern the stop padding, the risk cap, and the target multiple. Now the long block. The variable cross-up is true when the previous DeMarker reading was at or below the midline and the current reading is above it. The variable reclaim confirms a bullish candle. The close is above the open and above the previous close. When both are true, the code calls TrendEmaPeriod with true, opening along, and then resets the state. The short block is the exact mirror. Cross DN is true when DeMarker was at or above the midline and is now below it. Its reclaim requires a bearish candle, with the close below the open and below the previous close. When both align, the code calls TrendEmaPeriod with false for a short. Finally, the entry itself. The take profit is computed as the entry price plus or minus the reward risk multiple times the measured risk. Then the code calls trade.buy for longs or trade.sell for shorts, passing the stop loss and take profit directly. That is the whole entry engine in a nutshell. This walkthrough is purely educational. Let's walk through this illustration candle by candle. The blue line running under the candles is the trend EMA, and the gold line in the lower panel is the DeMarker oscillator, with 3 reference lines. The midline at 0.50, the dip level at 0.45, and the short reset at 0.55. We begin on the left in a clean uptrend. The first 2 candles push higher and close well above the rising blue moving average. Price is on the correct side of the average, and the average is sloping up firmly, so the trend filter is satisfied for longs. Notice the oscillator sitting comfortably in the upper region during this thrust. Now the third and fourth candles pull back. These are lower highs, and the pullback is orderly, not a collapse. As price eases off, the DeMarker oscillator slides down and, on the fourth candle, dips to the 0.45 dip level. This is the shallow reset the strategy is looking for. Because the trend is still confirmed, the long setup is now armed. Importantly, the oscillator never plunged to a deep extreme. It just paused at the reset. On the fifth candle, momentum re-engages. This is a strong bullish reclaim bar that closes above its open and above the previous close, and the oscillator crosses back up through the 0.50 midline. That cross, on a bullish bar, in an uptrend, after a shallow reset, is the trigger. The buy entry marker fires here. The stop is tucked just below the recent swing low of the pullback, and the take profit target sits at twice that risk. From there, the 6th, 7th, and 8th candles carry price steadily higher along the trend. On the 8th candle, price reaches the take profit marker, completing the long as a reward to risk of 2-to-1. Notice how the entry sat right off the reset, keeping the initial risk tight. Now watch the character change. Around the 9th and 10th candles, price rolls over, closing back below the blue average, and the average itself begins to fall. The trend filter now qualifies the market for shorts instead. The 11th candle extends the decline, and the oscillator drops into its lower region, confirming downside momentum. On the 12th candle, price bounces slightly, a shallow retrace higher within the downtrend. That bounce lifts the DeMarker oscillator up to the 0.55 short reset line. Because the downtrend is intact, the short setup is now armed. Then the 13th candle delivers a bearish reclaim bar, closing below its open and below the previous close, while the oscillator crosses back down through the 0.50 midline. That is the mirror image trigger, and the sell entry marker fires. The stop is placed just above the recent swing high, again keeping risk controlled. The 14th and 15th candles then push lower with the trend, and price reaches the take profit marker on the final candle. Once more a 2-to-1 reward to risk outcome. In both examples, the pattern is the same. Confirm the trend, wait for a shallow reset rather than a deep extreme, and enter only when the midline is reclaimed in the trend's direction. This is an illustration of the mechanics, not a prediction of results. So there we have it. Today we explored DeMarker Pullback Continuation, an expert advisor that reuses Tom DeMarker's DeMarker oscillator for trend continuation rather than extreme fading. We covered how the EMA and slope gate confirm the trend, how a shallow reset near 0.45 arms a setup, and how a reclaim of the 0.50 midline triggers an entry in the trend's direction. We also walked through the code and a candle-by-candle chart, including the structural stop, the reward-to-risk target, break-even, and the ATR trail. Remember, everything here is educational information only and not financial advice. Trading always carries risk, including the risk of loss. If you found this useful, please like, subscribe, and leave a comment with the strategy you'd like next. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.